All right, so how do you find a higher time frame bias, right? How do you simplify the approach? Okay, so I'm going to give you some steps to simplify this approach, right? So we have a structural low and we have a structural high over here. This is our structural range. We've broken structure to the left over here. Now we have what we call our Fibonacci tool, right? So the Fibonacci tool, you only ever need three numbers, and the middle number is the most important. You don't even need the 0 and the 100. You actually need the 50. What is your bias now on ES and NQ? So this is ES on the 4-hour time frame. What I want traders to understand is one thing, right? This is my key level, right? This is my key level. Why have I drawn the key level like this? People get confused between breakers, order blocks, fair value gaps, OTEs, or whatever you want to call it, right? So what I'm looking for is essentially an inefficiency in the market. So I am looking for a fair value gap. We have a fair value gap in this region. This is a very, very large fair value gap, and I expect the market to fill this, right? Look at how large this imbalance actually is. Very, very big imbalance, right? So what's important to understand is that the key level is different to the fair value gap. This is the fair value gap, but this is the key level. So now that we've had such a large gap to the downside, I expect price to head lower into this region, fill this area, and then head higher. And the way you find your key levels is by understanding this 50% level. Always sell into a discount and always buy back up into a premium, right? So don't get this confused, right? This is your fair value gap, but this is your key level. If you haven't studied fair value gaps and key levels enough, this is what's giving you the errors in your trading. So go back and study this.